Fed Day recap. Oh my goodness, what a day. With all my boxes. That's everything I own, by the way. I'm living in a garage right now. But let's talk about what the Federal Reserve decided to do today. I'm going to talk about where the Fed has been, where we are right now, and where we can expect the Fed to go in the future, as well as answer some listener questions toward the end of the video. As we all know, inflation has been a massive issue, and the Federal Reserve is in charge with dealing with that. And the way that they deal with that is through rate cuts and their balance sheet. So they have been raising rates in order to battle inflation. And the idea behind raising rates is like, hey, we're going to make everything really expensive. It's going to be expensive to borrow money to get a house, to borrow money to get a car. It's going to be expensive to be alive. So hopefully you stop buying so much stuff, the economy slows down, and then inflation slows down. And this kind of worked. Also, supply chains normalized, which was a big part of the inflation recovery. But about a year ago, the Fed was like, okay, we kind of like this inflation picture that we're seeing. So we're going to hold rates steady. This was July 2023. We're going to hold rates steady at a 40-year high. So rates are still really, really high, and monetary policy is still restrictive, right? Like, it's not like everything got easier once they stopped hiking. It was just like, we're kind of at this new normal, quote unquote. Since they decided to hold rates steady about a year ago, everyone has been asking the same questions for about a year, which is, when is the Fed going to cut rates? So the reason that the Federal Reserve would begin to cut rates is for two things. Number one, they're seeing concerns in the economy. They're like, okay, things are really slowing down. People are having trouble finding jobs. Like, inflation has definitely gone away. Or rates are just too high. Like, there's a neutral rate that we can get to that doesn't need to be as high as it's at. We don't need to have the economy be this restrictive all the time. We can operate at a more normal level. That is why the Federal Reserve would begin to cut rates, is because they're seeing improvements and they're like, okay, we can, let off the brakes a bit. And so a lot of people wanted the Federal Reserve to cut rates today. The main reason why they wanted the Fed to cut rates was because the reason that the Federal Reserve was able to raise rates so quickly was because of the dual mandate. So we have price stability and we have maximum employment. That's the two sides of the Fed's dual mandate. But basically, they're in charge of inflation, and they're in charge of making sure that if people want a job, they'll be able to sort of get one. They were able to raise rates so quickly because the labor market was so strong. People were able to get jobs. They were able to get hired. We were seeing wage gains, right? And so that's starting to shift. The labor market is becoming a point of concern. Any sort of data point, jolts and quits, anything that you look at is telling a story of a slowing labor market. And so for the Federal Reserve, they're going to have to sit back and be like, okay, all right, so this side of the dual mandate is saying that the economy needs some help. We're paying attention to the concerns in the labor market, but also inflation. We want to make sure we have the inflation stuff under control. And so those are the two things that the Federal Reserve is trying to balance right now. They want inflation back down to 2%, which is their target. But they also don't want to wait too long, as the Wall Street Journal article pointed out, and have the economy not do so well under high rates. And so this is like the push and the pull. And he said sort of all the same things that we hear all the time, which is like, okay, yes, the Fed is paying attention to the data. The cuts will depend on the data. We're seeing a slower labor market, but we need more data. We need more data to see if a rate cut could be on the table in September. We're seeing further progress. We need to gain greater confidence, like all the keywords, right? There's expectations that the Fed will cut in September. There are about 70 basis points of cuts priced in for this year, which is up from 64 basis points before the meeting. That's like about 3 cuts, right? 25 basis point cuts each, unless they do a 50 basis point cut in September, which some people are saying that they should. So to recap the Federal Reserve was raising rates for a long time in order to battle inflation. They held rates steady because they were like, we like where inflation is going. But now the labor market is showing signs of concern, which is why some people are calling on the Fed to cut rates sooner rather than later, because we don't want to hold rates too high and have the economy be under undue pressure and have the soft landing go away because the inflation fight wasn't quite won yet. So it's tricky. And they do need more data before they make their decision. There's speculation that some members of the FOMC did want to cut rates today, but we'll see what they decide in September. So let's answer some listener questions now. So I'm going to paraphrase these. Does the amount of debt worry the Fed? So Jerome Powell gets asked this a lot, and he's always like, that's something for Congress to handle. Like, yes, the fiscal debt, the debt levels of government are concerning, but the Fed doesn't really have any control over that, right? And so I think for them, they're like, yikes, but it's like, that other guy needs to get that figured out, right? Because that's not part of the Fed's mandate to manage the public debt. Because rates are so high, the US government has had extremely high interest payments on their debt. Because the Fed was raising rates in order to battle inflation, it made everything more expensive, including government debt. And so I think the Fed is paying attention to that because, these interest payments outpaced what we spent on military. We did get an announcement from the Treasury saying that they're not going to have to borrow as much money because the Fed is not rolling as many assets off their balance sheet, but the amount of money that they expect to have at year end is going to be smaller than expected. And so there are some fiscal concerns. But that's the difference between fiscal and monetary policy. Fiscal policy is managed by the government, taxes, treasuries, etc. And then, of course, monetary policy is managed by the Federal Reserve. I talk about this in my book, In This Economy. It's available now for purchase. Does the Fed anticipate only one rate cut or cut more than one time? The market does anticipate about 3 rate cuts, as I was talking about. I think the Fed is, very much paying attention to data and have a lot of room to cut rates if they need. That's what Jerome Powell said. He was like, if this economy starts freaking, like, we have rates so high that we have a lot of leverage if we do need to respond with rate cuts. So the Fed doesn't tell us this directly, but it does release a summary of economic projections, which they released at their June meeting, that tells you where members of the FOMC expect rates to be. And so it comes in the form of a dot plot, if you've heard that word being tossed around a couple of times. As of the June meeting, many people expected that rates would be back down to about 4% into 2025. So that would be about 125 basis points of cutting. And so we do kind of get an indication of what they think could happen, but they don't tell us directly. The market sees 70 basis points of Fed cuts in 2024. If you look at the dot plot for 2024, most people seem to expect around 1 cut. Okay, mentioning rate cuts is bold. I don't think it's bold. Rates have been at this 40-year high, and everyone's like, when are they going to lower rates? When are they going to do it? Jerome Powell did say that a reduction in the policy rate could be on the table as soon as the next meeting in September, getting closer to the point at which it'll be appropriate to reduce our policy rate, but we're not quite at that point. So yeah, mentioning a September rate cut isn't bold because for Jerome Powell, he is like a snake charmer of the market. And so you can't freak the market out. You have to be like, hey, no, listen, we might cut rates in September. We might. You have to like whisper it in their ear. And then they'll be like, okay, we know what to do, we know. You can't surprise anything. Like, that is sort of the worst possible thing for the Fed to do, is surprise markets, because then markets freak out, and then everybody freaks out, and the Fed has to respond to that. And so it just ends up being this whole nightmare. You just don't want to surprise markets. They're babies. Like, you really gotta be like, hush, little darling, Higher interest rates causing higher inflation. So I've made a couple of videos about this because I think it's really interesting, specifically with the housing market, which I really think is really important to consider. There has been speculation that higher interest rates have exacerbated housing affordability because it's so hard to build a home with rates so high. People are like, I'm just not going to deal with this. There was another question about housing affordability, so I'm just going to wrap these two into one answer. But the number of housing units under construction plateaued in 2022 after borrowing costs soared, but residential construction turned negative earlier this year, down nearly 8% in June from a year earlier, the biggest drop since the Great Recession, which is not good. Also, mortgage rates are sky high because the Fed has been raising rates in order to battle inflation, as we all know, and so all rates become really high. You have this like push and pull in the housing market, where the main problem with the housing market is we just don't have enough homes, right? We have this many people, like we have 4 people, and we have one home for all of them. And so they're all like, okay, how do I get into this house? Mortgage rates are really high. The key thing for them to do would be to have like 4 houses, but that's not going to happen. So we're going to have to battle over this house, and we're all going to push the price of this house up and up and up and up and up. because one of us has to win, and that's the laws of supply and demand, is that if there isn't enough of something, the price of that will get bid upward. That's the thing that's happening with the housing market. Nobody can afford to, these four guys can't afford to finance a home, and then also there are just not enough homes being built. The short and long-term implications of a rate cut. And so this is an interesting question. The question about housing affordability was like, if they cut rates, can I afford a home? It would help. Mortgage rates would go down, the borrowing costs would go down. There would be some element of exuberance in markets because they're like, finally, even though I'm sure most of the rate cuts are already priced in because everything is priced in all of the time. And so from that level, it would improve affordability. They wouldn't be waiting too long to cut rates, so they would remove that risk. The other worry is that inflation would become entrenched if they decide to start cutting too early. If they don't really win the inflation battle and it keeps on getting worse, and then we have to start a rate hiking cycle yet again. The short-term implications are that borrowing costs would lower, there would probably be a loosening in lending, like things would just get a little bit quote unquote easier. That's the goal of cutting rates. The long-term implications would be that they cut too soon. But I think the economy does seem ready for a rate cut cycle, but we will see. One thing that the ECB, the European Central Bank, talked about was that it doesn't have to be a pure cycle anymore. Like, we can cut and lower rates within the same time frame. Like, it doesn't have to be like cut, hike, like it can be cut, hike. So I don't know, but that's what happened with the FOMC meeting today. As usual, waiting to see what's going to happen next. September could be really interesting. There's political pressure on that. A journalist did ask Jerome Powell about that today, and he went into a long talk about how he's been through 4 presidential terms at the Fed and that they're guided by data and that they're non-political. They're trying to do the best that they can to support the economy. But yeah, Verity, as always, interesting times, especially going into a few months of immense uncertainty. So we will see what happens. But thanks so much for listening. Thanks so much for hanging out. I also have a survey. If you want to fill that out, it's about economics education. It is for a presentation I'm giving tomorrow. If you're listening on Wednesday, July 31st, if you're listening a few days later, I've already given the presentation and I hope it went well at the Symposium for Economics Teaching in Blacksburg, Virginia. And if you want to buy my book, it's called In This Economy. I explain all the stuff I talked about in this video more in depth. I also have drawings in the book, over 60 illustrations, all done by me. There's an audiobook version, as well as an ebook and a print book. If you want to order a signed copy, you can order it from the Boulder bookstore and support local. They're great people there. And then you can follow me on all platforms. I'm on TikTok, I'm on Instagram, I'm on YouTube, I'm on Kyla.substack.com, where I'll be publishing a little bit more frequently, and I'm on Strava. I hope that you all are doing okay out there, and I'll talk to you very soon.